Well, I just want to thank Bobby for showing up today on the live. We haven't been posting that we're going live on Thursdays because you never know what happens in our lives, right? So this way, it's just when we definitely go Tuesdays and Thursdays at 11 a.m. It's just a matter of who we have on. Last week earlier this week we had Mike Douglas on from the Mike Douglas Show, and we talked about why we do what we do. But today's show is about something totally different. I guess that you. By the way, thanks for being here. Say hello.
Yeah. Thanks so much, Ed. I appreciate it.
All right. Anyway, so so today you said you want to do home loans 101. So we're going to change the roles today.
Okay.
You're going to be. Hold on. Let me get you over there. There you are. Now you're in charge.
I'm on the other side. So one thing I was thinking about is, even as a second time home buyer going through the process, there's a lot of questions that don't get answered unless you ask them. And so I thought we should just do like a whole series of just down, nitty gritty basics. So I figured the first one we should ask about is loans, because a lot of times that's the first hurdle to people purchasing a home. Either they're afraid to ask the question or they don't know what questions to ask. And so I wanted to go over the main types of loans that we use. Last week, we already talked about VA. So if anyone wants to go back and refer to that, please do. If you have any questions, let us know in the comments below. But the first one I wanted to ask you about, Ed, was...
You can ask me this one. And just so if people want to know where to look for that, that's either on your feed or my feed on Edward Parcaut, or on the YouTube channel for Real Estate Jerky Live. You can go there and check that stuff. I just want to make sure they know where to go. And I want to add one more thing to what you say. A lot of people don't want to be judged, right? They think that it's going to be judged with what happened to them, all this kind of stuff. And I try to explain to people, if it's happened to you, it's probably happened to me. So I have no judgment. Just come here. We'll help you. We'll get you on the path. If it's not today, if we say no, it's not that it's a no, it's a not today. Let's get this thing in place so that you can purchase in 1 month, 2 months, 6 months, whatever that is, a year. I've had people on plans for a whole year and then they end up purchasing. There's nothing like that feeling of owning your own home. So I'll shut up. Go ahead until you ask me a question.
No, that's one thing I was going to touch on, is that it's pretty common, myself included. When I bought my first home, we ran my credit and I was a 580. And the lender I went through said, "Hey man, you have some work to do. You're not buying a house right now." And so it took me about 6 months, and I had some things I had to pay off. I had some debt that I didn't even know about when I got out of the Navy that was from Virginia Beach that I had to pay off. Anyway, long story short, he got that resolved. We got in our first home. So I wanted to start off with the main three kind of loans that we're going to be looking at right now. So if you could explain to me what FHA loans are and what FHA actually means.
Federal Housing Administration. So if you want to go way back, 1930-ish, right after the Great Depression. So back then, when you bought a house, it was a short-term loan, like 5 years, that kind of stuff. There was no long-term. We're coming up on the holiday season. You can watch It's a Wonderful Life. Basically, that's really how that is. The savings on loans and those kind of things, that's really all there was. Well, then they came out with the Federal Housing Administration, and they created the FHA loan, which allows people to buy a home with 3.5% down, where before you had to have 20 or whatever they would let you buy the house at. So it's a lot harder. So this allowed people to do it. And now with the FHA loan, your FICO score can be as low as, like you said, originally 580, what yours was. We can do that, but I don't want to.
Yeah.
And the reason is because you're going to be frustrated as much as we're going to be frustrated. We have to go through manual underwrite, other things that we don't have to do normally on loan. So it's so much easier if you can add, just go through the process and even get to a 620. So prior to the pandemic, a 620 we could do all day long, no issues, no big deal. And then it got really tough during that, and it went up to 660 or 680 for a lot of companies. Now it's back down to where it kind of was before, and the interest rates are there. But it's so much better to go from, you hit your head against the wall. I don't know how to explain this, but if you have a 580 versus a 620, it's just good. They're crossing the T's and dotting the I's really bad. I've had people go, I can't believe they're asking me this. Well, they're asking you this because your FICO score is under 620. If if we can just get it above that, a 640 difference in rate is a huge difference. And a 680 is like night and day difference on an FHA loan. Anyway, so what FHA loan allows you to do is it allows you to buy at 3.5% down. So that means for every $100,000 that you're borrowing, that's $3,500, right? So on 300,000, you're looking at about a little over 10 grand, right? Do you want me to do the math? We'll be here for hours. We don't have a whiteboard behind me. We'll get it. Yeah. All right. So All right. Someone's, I don't know, April Potter said me joining in. Can't wait to hear about this. All right. Well, I'm glad you're here. All right. So
Hi, April.
basically, yeah. So the FHA loan, but what that allows us also to do is there's this thing called your debt to income ratio. And basically what that means is for every dollar you bring in, how much cents can go towards your mortgage and how much cents can go towards your mortgage and your other debt. That is the huge other factor. All right. So when we look at FHA, it allows us to go up to basically the highest back end ratio is 56. That means for every dollar you bring in, 56 cents can go towards debt and your mortgage. On conventional, it's only 50 cents. Right. So it allows you to push those numbers a little bit more. And a lot of people go, well, I don't want to do that. Well, sometimes people's income's down a little bit, or certain things are different, or we can't use overtime because they haven't been there long enough, but we know they make that money, but they haven't had a 2-year history of the overtime to be able to use that, or had a company prior to where they're at. If I get off on a gambit or go a totally different way, just shut me up and tell me go back. All right.
No, you're good. You're good.
All right. So basically with the FHA though, it allows for other issues that come up that conventional will not. And it allows other things like, because you can go conventional with 3% down, but again, your FICO score has got to be over 700 to make sense for you to go that way. If you have a 680 or lower FICO score, you're going to go FHA all day long. That's the best program. So if we can get you above 700 FICO score, then we can go something else. But the big change in FHA a couple of years ago is with the mortgage insurance. So if you don't put 20% down, you have to have mortgage insurance. It used to be with FHA, after you paid it down to a certain point, 78% LTV, it would come off. We're talking years ago. They changed that. Now it's on there for life, unless you put 10% down or whatever. And people go, well, I thought it was only 3.5. Well, I can do a 540 FICO score if you got 10% down all day long.
No kidding.
Yeah. But then the mortgage insurance will only stay on there for 11 years. You follow me there?
Yeah.
So I've even had people who had $200,000 in equity in their homes, but they went FHA because that was the only way they could qualify for that house, because they had a foreclosure in the last 2 years or 3 years, whatever the time point was. And so they did that, and then they didn't care because the mortgage insurance would fall off, and the FHA rates are cheaper or less expensive than conventional rates. Did you know that?
No, I did not.
So, I always say they're kind of subsidized by the government, but basically they are. So if I'm quoting a rate today, conventional, say you have the same FICO score, say if it's 720 FICO score, the conventional is going to be around 3 something, and the FHA is going to be around probably 2.5, 2.625 for the same, rebate or cost or whatever that number is. Yeah. So but the issue is conventional. I know we haven't got there, but I'm going all over. But conventional allows you to take the mortgage insurance off. As soon as you get down to 80% LTV, you can ask for it to be removed. And I say ask because they don't have to, according to the servicing guidelines. It says you can ask, but once it hits 78% LTV, then it will automatically come off. And yes, you can refinance it through this period of time, but a lot of people we put into 2% last year are not going to be refinancing to get out of their mortgage insurance.
True. And that is kind of segue into what I was going to ask next was, what is the difference in between a 3% conventional and a FHA, and why would you want to choose that route? Obviously, you already explained the FICO score.
That's the reason.
Now, are there other things that are allowable with the conventional loan that you can't have with the FHA?
Well, there could be issues like if they had some dry rot or some other stuff that the conventional might not look at the same as they would under FHA guidelines. But pretty much the FHA appraisers have changed to where they don't call as much as they used to call. They kind of do it in the same line as the conventional. The big difference is just really your FICO score for us. In Tuolumne County, there's a lot of dry rot where that most of the time won't be called for on a conventional loan, but might be on a FHA. Plus the other issue is purchase price. Right.
True.
FHA has a county max purchase price. Like conventional right now is 625,000 in our county, right? In the average counties. Then you have this thing called high balance where you can go above that, like in the Bay Area and San Diego and LA and other places where they have high balances or higher things. So there's many different ways of why you go conventional versus FHA. But for most people, like I think and bear with me here, I'm just going to throw this out because I can't remember off the top of my head. I had my Moderna shot yesterday, so I'm a little under the weather. That's my excuse, my booster. the issue is the fact that your fight, where was I going with this? Conventional and FHA. So right now in our area, say that the max FHA is 410 because of the max loan amount is 370 something, right? Conventional, the max is 625 with 3% down.
Yeah, that's
There's
a
a
big difference. Yeah.
Yeah.
Now with the 20% conventional, that's the traditional one that everyone thinks that they have to purchase a home, right? So what would be the reason for doing a 20% conventional?
Because you have the cash.
And just to have a lower monthly
And
payment, just finance
yes,
less?
but I tell a lot of people who want to put 20% down, and that's all their money. And I tell them, no, let's run some different scenarios. We now have a program that just came out this week where if it's 10% down, 10%, if it's at 10% down, there's no mortgage insurance.
Yeah.
That just came out. So
it just came out. Okay.
Yeah. So every other conventional loan, if you're not putting 20% down, you have to have mortgage insurance. There was another way to get around it where you added it to the rate. The rate was just a little bit higher, and the mortgage insurance was actually on the rate, not a monthly factor. And I've done that a lot. But this is just a totally different animal that as long as you're 89.999%, you don't have mortgage insurance with these programs. And that's through the wholesale lender we work with.
And that's kind of why I wanted to do this 101, just the basics, right? Because a lot of folks won't be as intimidated to call. If they watch this ahead of time, they can call. They have some knowledge. They can call you and they can say, hey, I already watched the live. I already know what you're talking about, Ed.
Yeah, but even with what we've talked about here, they don't really know. And please don't take this wrong if you're listening to what I'm saying. It's overwhelming. I mean, the one thing about our industry is if you don't like how it is today, just wait till tomorrow. It'll be totally different, right?
Yeah.
And the mortgage, and the same thing is like this week, there's new things that came out, and that's great, and it changes a lot of things. But then sometimes it's the complete opposite. We don't know what the max FHA is going to be next year. So it'll be any time we'll know that. The positive thing, like we talked about VA last year, it's totally changed. It's the same no matter when it is. Conventional just went to 625, which helps out a lot especially in our area for conventional loan, right?
Absolutely.
Because we don't have a high balance in our area. And if you don't know what high balance is that's what I talked about earlier, where it goes over the conforming loan limit depending on the county you're in. Like over in the Bay, it could be up to 699. It could be up to 728. It could be higher than that, right? And that's just a difference in the interest rate. So, I mean, because a lot of people I'm talking to over in the Bay, they're shocked how expensive their house went to. I've talked to 4 people in the last 2 days that they're at 1.4 million for their house. And they bought it for 600,000 10 years ago.
Great investment, huh?
Great investment. House purchases are a great investment anywhere. That's how you build personal wealth, right?
Absolutely.
Besides your 401k and 403b or IRA, most people don't have those or invest in those. You have 2 choices. You can pay the mortgage of your mortgage, or you can pay your landlord's mortgage. I recommend paying your own mortgage. And the way it is today with rents are almost as much as the mortgage payment is.
Yeah. Well, and another thing I've been telling a lot of renters is that now that they have the rent cap of 5% annually, what they've done is they forced the hand of every single landlord to guarantee there's going to be a 5% increase every year. Where it used to be landlords would increase, maybe every other lease term, and they'd say, okay, well, we're a little below market. Let's go ahead and give them a $50 increase. Now what they're saying is let's give a 5% every time, because if we don't, we wait another year, we're never going to get this person to market. And so 5% on a 1650 is like $85 roughly, right?
Right.
And so a lot of properties are also doing a thing where they used to include utilities, and now what they're doing is they're going to go ahead and split it up. They'll take the bill and split it up amongst the number of units. And so that doesn't count as a rent increase because it falls under utilities. So a lot of renters are going to be seeing increases collectively of maybe up to $150, $200 with these lease renewals coming up.
Right. And I've been asked, I do a lot of stuff lately on TikTok and other thing where people ask these questions, and I pull them out every day and ask them. One of them was because my mortgage payment increased. Your principal and interest payment cannot increase. But what we didn't talk about is your impound account. So if you don't put 20% down on average, you have to have an impound account, which pays your taxes and then twice a year and pays your insurance once a year. We have to pre-fund that when you get the home loan. So that depending on the time of the year, it depends on how many months. It's always between 2 and 3 months for insurance, but the tax can go from 2 months all the way up to 9 months or 10 months to pre-fund these things. And that is where your mortgage payment can increase or decrease. A lot of times people's insurance change. The lender will pay it, and then they become a deficit in that impound account because it hasn't updated with your payment. And then they say, oh, we have a deficit, and it's good. Now we have to raise your payment by $50 a month to make up the deficit, and another 25 to be right with the insurance. This is happening a lot wherever there's fire insurance. So I tell a lot of people, don't impound the hazard insurance. Keep that separately, keep that outside, do the taxes. That's your biggest bill. But the insurance, you could pay that monthly or whatever. And you don't have to impound. We don't have to impound on VA with our programs, which is unheard of. So,
gotcha.
And I'm not trying to not say, oh, I'm so great. It's just, we found ways to get around some of the biggest headaches. When you're buying the house, to set up your impound account on average could be $3,500 to $6,000, depending on what, if you're buying a $625,000 house, your taxes are going to be, a year, that's 1.25 of whatever the purchase price is, right? So that's, it'll be almost $7,000 divided by 12. Let's just say it's $600 a month. You got to preload it with 5. That's $3,000 just right there.
Yeah.
So don't be scared from what I'm telling people. Just let me run. Let me. I felt like a dog there. Let me run through the numbers, and we'll figure a way that we can get this done. The positive thing that's happened lately is it's almost like pre-pandemic, where we're starting to get some extra rebate. And what rebate is money that we get if we have a par rate. So say that your rate is 2.75 and it doesn't cost anything. If we went to 2.875, we might get $1,500 towards that we could use towards closing costs. Sometimes that could be $2,500. If we go to 3%, we could possibly have $3,500 to $4,000 to help you with your closing costs. Where they used to be able to go to the seller and say, hey, we need help with closing costs, so we're going to give you this and then add this on top of it. It's really competitive now. Nobody wants that because they don't think you have the money, and they don't, because it's still a seller's market. So the best way to do that is if you don't have it, get it as a gift. Oh, that's the other thing I didn't bring up. All these programs, gifts. You can get gifted your money for your down payment. You can get gifted your money for your closing costs. That means somebody in your family can gift you that money, right? It doesn't all have to come from you. Or look at if you have a 401k, 403b, or IRA, you can take sometimes money out of there towards the purchase and not pay the penalties on it that you would if you just took it out.
So long story short, Ed is definitely the expert in this field. So if you guys have ever any questions, feel free to give me a call, or I can refer you to him. Reach out to him independently. I appreciate you for your time, Ed. I know you're feeling a little under the weather, so thank you for coming in today and doing this live with me.
Hey, no problem. Thank you. And what's your phone number, Robert?
My number is 209-550-1087.
One more time.
209-550-1087.
Yeah, it's just like a radio. Mine's 209-404-1915. Again, that was 404-1915. You can always reach out to us through Messenger on Facebook. I'm on Instagram under Ed Parcaut. Also under TikTok the same way. If you want to find out more questions, other things, just follow us all those different places. And thanks for showing up today and watching us. And if you like what we do here, just follow us. And again, Robert, thanks for being here today. I know everybody calls you Bobby, but I'm so formal.
Either way. Thank you so much for your time, Ed. I appreciate it.
Thank you for doing this today.
Thank you, sir.